Good afternoon and welcome to a very special interview show of The Prode. The annual rate of inflation worldwide, as measured by the Consumer Price Index, accelerated to 9.2% in March 22. The inflation rate in March 22 was more than twice the rate of 3.7% recorded in March 21. Joining us today from New York to explain us the whole global inflation crisis is the former Deputy Governor of the Reserve Bank of India, former Director of the National Stock Exchange of India, someone who has served as the in charge of monetary policy, financial markets, and financial stability of India, and currently the CV Star Professor of Economics at the New York University Stern School of Business, Dr. Viral Acharya. Thank you so much, Professor, for your time and a very warm welcome to the show. Really appreciate that you're taking out the time to do this.
Thank you, Ritwij. Looking forward to the interaction on discussing the global inflation outlook.
Sir, I would like to begin the discussion by asking that the inflation is at 40 years high in the United States, and food prices in March were 9.1% higher than that of March 21. So how do you see this, and what is your assessment of this situation?
Yes, it's a confluence of fairly tricky circumstances. On the one hand, inflation had already been quite high, especially in the United States, even prior to the invasion of Ukraine. And this is largely a combination of heightened demand spurred by pandemic savings. And these savings, of course, have been boosted by, I would say, both the fiscal stimulus in the United States, as well as the very expansive monetary policy, which has created a lot of financial wealth through asset price inflation. So the backdrop prior to the war was that fuel prices had already started rising even prior to the war, not necessarily in the $100 per barrel range, but they had risen quite sharply since April of 2020. And there was a generalized inflation in services, consumer goods. And of course, this demand is hitting what I would call as sort of limited supply capacity of the global manufacturing system right now. There are many bottlenecks there, partly because of asynchronicity of pandemic-related lockdowns, some reorganization of supply chains that is underway. And I would say, in general, the lack of clarity as to what is the global trade order. Is the world moving towards sort of more polarized trading system? Is it moving towards countries becoming more protectionist? And with that level of uncertainty, you can imagine that companies would not necessarily want to sit on high levels of inventory, hoping that demand might come in. So now on top of that, you have the invasion of Ukraine, which on the one hand risks, especially given the sanctions, prices of fuel. But I think equally importantly, as you stress, is the fact that food, fertilizers, certain critical metals, they are also all experiencing supply shortages, further disruptions to the supply chains because of the war. And one thing that's not as appreciated is that a small producer cannot suddenly start exporting a commodity just because it's in global demand. They need to do some work to get to that level. Similarly, the grade of wheat or metal that they are producing may also not be exactly compatible with the imports that have been affected in the rest of the world. So it takes a while for these supply chains to adjust themselves. And the last point I would make here is that in this kind of environment, there's always a danger that countries start pursuing beggar thy neighbor policies. So, they would like to ban exports because they have to contain domestic consumption.
Yeah.
Of course, it doesn't work because now other countries will stop providing their comparative advantage goods to you. And overall effect is just a ratcheting of aggregate inflation because everyone's hoarding commodities in their own country rather than supplying it in a global market. So a very, very tricky set of circumstances, as I said. In United States, the Federal Reserve has now sort of embarked on a tightening policy. The anticipation is that rate hikes may be very fast, and perhaps another 2.5 to 3 percentage point interest rate hikes are expected by the market in the next 12 months. Bank of England seems to be on a similar path. The European Central Bank may go down this path sometime later in the year. Bank of Japan, we don't have much clarity yet. So the bottom line is that high inflation way above the target levels in the systemically important central banking countries implies that they will embark on a very tight monetary cycle, given they were so expansive, and they want to maintain credibility of their inflation targets. So while the inflation, of course, is high in the developed countries, I think the brunt of this, I fear, is going to be borne very heavily by the emerging markets and the poor economies. Their consumption baskets are very heavily loaded towards food and fuel. The demographics are such that the lower income segments form a larger proportion of the demographics. And so they are the ones who are most heavily impacted by inflation, partly because they've not had the benefit of financial assets having delivered through inflation gains along the way. And last, they don't have much fiscal or monetary capacity, in my view, to deal with this larger shock, because in a way, whatever capacity they had, they already expended right after the pandemic. In many emerging markets, also real rates were pushed to negative levels, even though the overall tightening cycle in emerging markets sort of this time around was before the Fed actually started tightening, barring a few exceptions. So yeah, we have to wait and see, but emerging markets will most likely have to deploy a range of policies at all levels in order to deal with this situation, because the options are somewhat limited on the table.
Yeah. So the US Central Bank has announced its biggest interest rate increase in more than 2 decades to fight against the rising prices. So how efficient will the move be in order to counter the inflation? And how long do you think the people have to wait in order to see the prices falling back to normal, if there is a possibility?
Monetary policy does take a little bit of time to transmit to the real economy, even in developed economies and well-lubricated financial markets such as in the United States. But there will be a pass-through. Partly the Fed will want to push rates very high very quickly so that the pass-through happens a little faster. It's often said that if you want a faster pass-through, you have to sort of raise interest rates by larger amounts. The pass-through will happen through the mortgage rates, the auto loan rates. It has to be kept in mind that this tightening cycle is happening in the midst of very high oil prices. Oil prices have now stabilized above $100 per barrel. A scenario that most people thought was a stress scenario 6 to 9 months back is now the middle of the distribution. And oil price volatility is still very high, so there is more upside to these oil prices from here on. What that means is that typically oil price shocks of this magnitude, which is like 40 to 50% increase in a short period of time, they do have quite a depressive effect on consumption. Once again, I stress the point that oil and gas are a very big part of the expenditures for the lowest income households. So their consumption will probably get affected the most severely. This could have some spillover effects onto the auto sales markets, which are already struggling to an extent because of lack of supply. But now, there could be a reduction in the volume of activity as well. So, it's anybody's guess as to how quick the transmission would happen, but typically it does take 6 to 12 months at a minimum. What that means is that the prints of inflation may have some space to go up before they start coming down. I was just looking at prices of air tickets, extent of travel bookings, and so on. And it seems the US consumer is still planning quite actively for this summer. I don't have a good sense of whether there are already these divergences showing up in the demographics based on wealth levels. And it could very well be that the expenditures are continuing at a fast pace only for the very wealthy, but at the lower income brackets, perhaps the consumption is already beginning to show some signs of slowing down. So I think we have to see. I think one big elephant in the room is whether the financial markets will remain stable in the wake of such strong tightening cycle. Corporate bond markets have a bit of froth in terms of issuances, first post the global financial crisis and then post the pandemic. We know that stock markets have had a fairly phenomenal run, especially for the tech stocks and, all other kinds of attractive, short-term attractive assets. Many of these are correcting at a very fast pace in their valuations. We know that, crypto assets are sort of tumbling at double-digit levels, sort of every week, if not every day. Stable coins that in some sense are being stress tested for the first time on their stability are a question mark right now. So there's all other kinds of transmission mechanisms that are possible. I read somewhere that some of these stable coins are themselves holding a decent chunk of assets in the global economy. So if they get redemptions and they are forced to liquidate many of the potentially even the crypto meltdown could lead to some financial amplifiers. If those amplifiers take hold, and the worst case, if there is something like a financial crisis, then of course you could have a very sharp slowdown very soon. As of now, the expectation is that the US economy, with a very high likelihood, will experience a recession in 6 to 12 months' time, and that what the Fed really needs to try and avoid a hard landing in the form of a financial market accident or a crisis.
So now coming to the Indian scenario, the Indian currency plunged to a record low at 77.55 against the US dollar in early trade on Thursday. So what, according to you, is the primary reason behind the same, and how it will affect the food prices and other expenses, including education and healthcare in the country?
So I think there are multiple reasons. First and foremost is that India's levels of inflation are also high. Food and fuel have now both pushed it up very sharply. But I would say even our core inflation had been steadily inching up over the last 2-3 years, closer to 6% or that territory. So it's, I think, not just food and fuel. There is a little bit of generalized inflation. Our wholesale price inflation has been in double digits for quite a while. And there's a growing sense that there might be a cost push that has not yet happened, which is that there's a segment that has not yet pushed its input costs down to the end consumer. So again, there might be some space for inflation to go up even higher potentially. Now, of course, that means that if the Indian central bank is seen to be a bit behind in the tightening cycle than the United States and other countries, then Indian inflation is also expected to come down somewhat later than in these other countries. And that would mean the currency has to depreciate in order to equate sort of what you can do in real terms with 1 unit of each currency. So that's one point. Second, of course, the Indian central bank has amassed a very healthy stock of reserves over the last several years. What is happening, though, is that the US treasuries are losing value as the Fed rate hike surprises keep coming to the table. Essentially, in a stagflation kind of a risk, one has to keep in mind that not only will volatility rise, stock markets correct, but also the treasuries will lose their value. Now, on the one hand, dollar is strengthening because of all this uncertainty, but the value of the US treasuries in dollars is coming down at the same time. And that has a little bit of a risk to the emerging market central bank reserves, in my view, because they could be losing their value without being deployed in the market, simply because the treasuries are actually depreciating in value. So even if you assume that there is some standing repo facility with the Federal Reserve, you don't need to take your treasuries and sell them in the market. Of course, if the value depreciates, you can only borrow against the depreciated value. So that it's not the dollar that's depreciating, but the value of the treasuries is falling because of the hike in interest rates and the expectations of inflation. And the third and the last point is that India is always vulnerable to an oil price shock because, we primarily import all our sort of oil needs. There may be some bargains available here and there because of the war, but I think to me that's sort of decimal place rather than the significant digits of our import bill and calculations. So yeah, it means that the external sector balance in terms of current account balance, trade balance could also take a hit, and so it's sort of like the standard double whammy that India faces when oil prices rise, which is that on the one hand, imported inflation rises, and at the same time, our current account deficit widens. Um, uh, there are many positive things happening in India on the growth front, but some of the external sector issues are, I think, more intimately tied to the level of inflation, to the level of reserves and their stability, and I would say to the projected levels of current account deficit over the medium term.
Yeah. Sir, now coming to the food crisis. So recently there has been a lot of discussions on global food prices, and we know that how badly the crisis has created a shortage of food, especially wheat. So India has also decided to ban the commercial wheat export, but they will continue to provide wheat on a government-to-government basis for countries who are in need. So do you think that the food shortage will further increase the inflation around the globe, and we are at the door to see the worst inflation crisis of all time, as many experts argue? So what is your assessment?
Yeah, see, the food situation, in my view, goes a little bit beyond just thinking about inflation, and so does the current situation of fuel prices. But let's stick to food. One has to, at first and foremost, be concerned about food security, especially in poor emerging market economies. As you know, when food prices in India rise, the poor Indian consumer is even forced to adjust their basket in many ways that is not always nutritionally healthy for them, the families, the children. India has, of course, done remarkably well over the last decade structurally in improving its food security. But if you have the sort of heat wave that we are experiencing in the midst of the global issues on food trade related to the war, we have other countries simultaneously, considering export bans on some critical commodities that we import, such as palm oil. This is a very delicate situation, in my view. It requires deft management of existing food supplies and their distribution. It requires a proactive management of inflation by the central bank, and I would say reasonable supply measures that the governments can undertake. I think the main caution that perhaps we have to keep in mind is that we might not want to go down a path of beggar thy neighbor policies, because they could just be counteracted by other countries with their policy response, and we just end up in the global economy in a much worse space than if we continue to maintain healthy levels of trade at reasonable prices and tariffs. So yeah, my biggest concern with food and fuel price inflation in India is the dent that it will have on the consumption and the well-being of the very poor. And I think this can't be taken very lightly, in my view.
So I would like to conclude the discussion by asking that what is the way forward for big economies like India in order to counter the whole inflation situation? What steps are needed from the side of the Indian government?
I would say besides the obvious things we discussed, which is to use monetary policy and supply measures to keep inflation in check, or at least prevent it from escalating any further. I think we have to also ensure that we find ways to grow that are not as inflationary. And this could mean actually improving the structure of investment and job creation in the economy. Uh, Professor Raghuram Rajan from University of Chicago Booth School of Business has been pushing this idea along with his co-author Rohit Lamba that maybe India needs to pay as much attention to services as it is to manufacturing right now. That maybe our youth could be quite readily deployed in the global services space where we have a healthy presence to start with. I think it's an idea that certainly deserves careful scrutiny because our manufacturing has not been able to grow at a pace that it's creating the kind of jobs that we need every month. Second, I would say India should try and get more stable capital flows at this point as well. Our FDI has been healthy and robust over the last several years, but more can be done. Several of our sectors still face FDI restrictions. I wonder if both through ease of doing business in the country, reduction of the tariffs, and ease of the FDI restrictions, whether the environment for foreign entry into our country, into our important sectors, strategic partnerships with domestic industry, etc., can be improved. And third, I would say, we never seem to be pushing very fast on the disinvestment space. Of course, we've done the Air India, now we are doing the LIC, but we might want to think about doing even more of this on an almost programmatic basis, which is like you just do a little bit every month, and then you are averaging over prices, and it doesn't really matter so much. Why? Because I think the situation is such that if growth weakens substantially, India's debt to GDP dynamics, which have already taken a hit after the pandemic, could face some further stress. One way to minimize that stress is to actually quote unquote sell equity and diluting government stakes, maybe even to a point where you transfer ownership in some cases, like we've done with Air India. I think that I would put this on the table. I've been saying this for at least for the past 5 years, if not more. And I think it needs to be done. It needs to be made a program that happens automatically every week, certain percentage, or every month, certain percentage, so that you don't go into sort of gridlocks in bureaucracy, deadlocks in the political system. We just have to realize this is a more stable form of financing than debt right now. So I think these are the three additional factors, I would say, sort of focusing on service-based job creation and exploring that opportunity. Second, improving the FDI flows into the economy through another wave of liberalizations. And third, continuing on a faster pace of disinvestments and privatizations.
Yeah. Thank you so much, sir, for sharing your kind views. Really hope the situation gets better soon. And on this note, I want to end this interview. So thank you so much for joining and sharing your thoughts.
Thank you, Ritwij. It was very nice talking to you.
Thank you so much.